Hi, Larry Gaines, PowerCycleTrading.com. One of my very favorite option strategies is what we call a calendar diagonal. So it's a way to actually, it's a strategy that lets you take a directional play, but it lets you make money while you wait. So it's kind of an income directional trade strategy. It's got kind of the best of both. So let me show you an example. So here's Disney, here's a daily and a weekly. So I like the strategy when you think there's a potential for a bigger move or longer term move to the upside. So I like it when you're coming off, a kind of a low. So you can see Disney got hit real hard here, then bottomed out, had this really nice basing, stability basing foundation here down here around that 200-day moving average. And then we had this breakout after earnings, and they had Disney released its streaming service. So the market tends to like it. The service did real well today. It was so much demand that the site was down. But anyway, there's potential then for Disney to move higher over the next week, 2 weeks, 3 weeks, 4 weeks, etc. So we've got targets here, like to 140, up here to the 786, 142, 143, and then back towards those prior highs. So one way to trade this with an option strategy, that if you're not exactly right on the timing of the move up, and you can kind of look at it kind of like a covered call, is to do what we call a calendar diagonal. So let me show you kind of how this works. And it's a strategy that there's so many different little things that you can do to tweak it, that you can just adjust it numerous times, and just a lot of different ways that you can use this strategy. So let me just show you the basics of it. So you can kind of think of it as a call debit spread. So in this example, you'd be buying, you're buying the December 20 series 140 call. So pick that up at $1.67, went out at $2.67, went out at $2.76. But then at the same time as you buy the 140, you sell, in this situation, this example, we sold the 141 15 November call, which is expiration for this Friday, and got that at 37 cents. All right, so you could think of that as a call debit spread, but the difference here is, instead of selling the 141 call strike short in the 20 December series, so you'd have the 141 call debit spread here, we're doing it in a shorter duration option, the 15 November, which expires Friday. So there's going to be very accelerated theta decay. So if you look here, you can see the positive theta of $18.22. So we're taking advantage of that. So it's going to decay really quick, versus the longer dated, the December 20 140 has a theta decay, or a positive theta of 3.52. So it's what we call a positive delta theta play. So basically we're getting a really great positive theta of $13.97. And if this expires on this Friday below 141, we keep the full $37. That will adjust down our cost of the 140 call. And then what we'll do is we'll sell the next series out, the 22 November. We'll probably sell the 142 call, widening out that spread a little bit, bring in $73, and then we'll have even a better kind of a calendar diagonal on. So right now the spread is set up for $267 on the long side, and then we've got the $37 credit. So that is $230 at risk. And if we get Friday, but look here, I'm going to put my calendar here to my analytics. If on Friday the 15th, this goes out at 140 or 141, has potential to make over $130 profit just this week. Now, if it doesn't, we'll keep that $37, and we'll roll to the 22 November series, sell the 142 or 143 call against it, and just do it again. So it's a way that you can buy a long dated option at a discount. So you just keep whittling away at that long dated option, kind of like a covered call. Hope this helps. And if you'd like to learn more about it, I'll be doing a free webinar this Saturday on income option strategies, and this is one of my favorites that I'll cover at that free webinar. So sign up, and I'll see you Saturday.